Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's mission, we step away from charts and options and talk about something many beginners care about most, dividends. For this episode, the objective is to understand what dividends really are, how key dates work, and what makes a dividend reliable or fragile so we don't chase yield blindly. A dividend is a payment from a company to its shareholders, usually in cash, sometimes in additional shares. It's the company sharing a portion of its profit or free cash flow with the owners. That means you, if you hold the stock. It is important to understand, a dividend is not free money. The value comes from the business. When a company pays out cash, that cash leaves the company and typically gets reflected in the share price around the ex-dividend date. You as a trader or investor can usually choose between two basic scenarios what you will do with the dividend. Either collect it, meaning get paid in cash minus the tax, which is usually deducted from your dividend immediately, or reinvest the dividends, meaning you buy additional shares of the same company with the dividend payment. Some brokers offer the option of reinvest as simple as ticking a box. When it comes to dividends, there are 4 key dates you as a stock market participant should know from the top of your head. Declaration date. The day the company announces the dividend. How much per share and the calendar of record, ex-date and payment. Record date. The date by which you must be on the company's books as a shareholder to be entitled to the dividend. Ex-dividend date. The most important date for traders. If you buy on or after the ex-dividend date, you do not get the upcoming dividend. You need to own the stock before this date to be entitled to it. What is important here for you is to know the settlement cycle, as only after the settlement cycle has passed, you have technically become a shareholder of that company. Meaning, if the settlement cycle is +1 and ex-date is on 15th, you have to buy the share on the 13th just to be on the safe side. Payment date. The day the dividend actually hits your account as cash or reinvested shares. Out of those dates, most platforms will highlight the ex-dividend date because that is the real cutoff between who gets paid and who doesn't. What affects dividend payments? Dividends are not guaranteed. Companies set them based on profits and cash flow. A business must generate more cash than it needs for operations, debt, and investment before it can comfortably pay and grow dividends. Some companies may also take out loans to continue dividend payments, which can be a good or a bad thing, all depending on your perspective where you bought the shares. Generally speaking, if your game plan was to secure a relatively stable income for the next couple of years, you should pay close attention to how the company generates cash for payouts. Payout ratio. How much of earnings is paid out as dividends? Very high payout ratios can signal risk. If profits fail, the dividend might be cut. Industry and stability. Utilities, consumer staples, and big mature businesses tend to be more stable payers than aggressive, high-growth tech names. Sectors where investors usually look for dividend royalty are energy, utilities, and consumer staples. There are of course other sectors as well, but these have always been the go-to for dividend investors. Remember, dividends can be raised, kept flat, cut, or even suspended completely when conditions change. That is why understanding the business is just as important as looking at the yield. One quick side note at this point. There has always been a big debate on how to separate investing from trading. The way I see it, every investor is a trader, but not every trader is an investor. End goal for both is to make money and they both buy and sell. What separates the two is the holding period and the thesis to buy the stock. For a trader, the holding period will usually be shorter and he is looking to make money from price action. And for an investor, the holding period is usually longer and he will base his purchase on company's fundamentals and earnings potential. So, from my perspective, the whole trader-investor separation is a big ball of nothing, as when you strip it down to basics, they are both buying, selling, and looking to make money. If one makes 50 trades in a month and 2 trades in a year, it doesn't really matter if they are both making money. You will often see dividend yield, usually shown as percentage. It is calculated as annual dividend per share divided by current share price. For example, if a stock pays $2 per share per year and trades at 40, the yield is 5%. If price falls to 20 and the dividend is unchanged, the yield jumps to 10%. That can look attractive, but it can also be a warning sign. General rule, extremely high yields often signal stress. The market may be pricing in a future cut. Chasing yield without checking the health of the business is how many beginners get trapped. Over the long term, many income investors prefer steadily growing dividends over the highest possible yield today. You might hear terms like dividend aristocrat, dividend achiever, or dividend king. These refer to companies that have raised their dividend every year for a long time. Dividend aristocrats generate at least 25 consecutive years of dividend increases. Dividend kings, often defined as 50 plus consecutive years of increases. These labels suggest stability, discipline, and a shareholder-friendly culture. But they are not guarantees. Even long-term payers can cut dividends if conditions shift enough. Think of these titles as reputation badges, not promises. How dividends fit into a strategy? They are one part of your overall return. The other part is price movement. Together, they form total return. You can use dividends in different ways. Income focus, live off the cash flow or withdraw it regularly. Reinvestment focus, use a DRIP or dividend reinvestment plan, or manually reinvest dividends into more shares, compounding over time. Hybrid, reinvest in the early years, then switch to income later. You can access dividends through individual dividend stocks, those require more control, more research, or dividend-focused ETFs and funds, broader diversification, less single company risk. Now let's go quickly through some traps that ambush many new dividend investors. Buying purely for high yield without checking whether the business and cash flows can actually support that payout. Confusing the ex-dividend date with the payment date and being surprised when they don't receive a dividend they expected. Being shocked when the stock price drops by roughly the dividend amount on the ex-dividend date. Thinking dividends are extra and ignoring total return. Focusing only on income while the share price quietly trends down over years. Slow bleed. To summarize, dividends are tools. Used with understanding, they can be a powerful part of a long-term plan. Used blindly, they can disguise a weak business. They are simply a company sharing part of its profit with shareholders. Key dates, especially the ex-dividend date, determine who gets paid. The size and reliability of dividends depend on profits, payout ratios, and the underlying business, not magic. Labels like Dividend King are helpful signals, but not guarantees. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.